Chapter 1, Section 2, Understanding What a Short Sale Is. When Mark arrived at the office the next morning, Lisa already had a file waiting on the conference table. "I thought we defined what a short sale was yesterday," Mark said as he sat down. "We did," Lisa replied, "but understanding the definition and understanding why someone ends up in a short sale are two completely different things." She slid the file across the table. "This belongs to Tom and his wife, Emily." Mark opened the file and immediately noticed several documents: mortgage statements, property tax records, a recent comparative market analysis, bank statements, and a handwritten letter from Tom explaining their financial situation. Mark looked up. "This seems like a lot of paperwork." Lisa smiled. "And this is only the beginning." She pointed to the mortgage statement. "When most people hear the words short sale, they assume the homeowner simply wants to sell their house. That's usually not the case. Most homeowners never plan to be in this position. They're here because something in life changed." Lisa explained that one of the biggest misconceptions about short sales is believing they only happen when the real estate market declines. While changing market conditions can certainly contribute, she said, they're rarely the entire story. She pointed to Tom's hardship letter. 6 months ago, Tom lost his management position. A few weeks later, Emily underwent emergency surgery. Their household income was suddenly cut nearly in half, while their expenses continued to increase. Mark slowly nodded. They didn't wake up one morning and decide to stop making mortgage payments. Exactly. Most homeowners facing a short sale have exhausted every option they can think of before making that difficult phone call. Lisa explained that financial hardship can take many forms. Some homeowners experience layoffs or reductions in income. Others face unexpected medical expenses. Divorce, death of a spouse, military relocation, disability, or caring for a family member can all dramatically affect a household's finances. Sometimes homeowners have simply experienced several hardships at once. "It's important to remember," Lisa continued, "that every hardship is different. Our job isn't to judge. Our job is to educate our clients about their options and help them navigate the process professionally." Mark continued reading through the file. "I noticed the home is worth about $420,000, but they still owe nearly $465,000. Lisa nodded. "That's called negative equity. It simply means the homeowner owes more than the property's current market value." She explained that negative equity can develop for many reasons. Sometimes property values decline. Sometimes homeowners refinance and increase their loan balance. They purchased with a small down payment, and market appreciation never occurred as expected. Regardless of how it happened, the result is the same. Selling the property through a traditional transaction would not generate enough money to pay off the existing loans and closing costs. "That's where the lender enters the conversation," Lisa explained. "The lender has to decide whether accepting a short sale today makes better financial sense than completing a foreclosure months from now." Mark looked surprised. "So lenders don't approve short sales because they're trying to help the homeowner?" Lisa smiled. "While lenders certainly work with borrowers experiencing hardship, they're also making a business decision." She explained that foreclosure is often far more expensive than many people realize. Legal fees, property maintenance, insurance, security, evictions, utilities, repairs, months of carrying costs while the property sits vacant. Every day the property remains unsold costs the lender additional money. If approving a short sale reduces those losses, everyone may benefit. Lisa reminded Mark that lenders review every file individually. No two short sales are exactly alike. Some lenders may request additional financial documentation. Others may require updated property valuations or revised contracts before making a final decision. Because every lender has different guidelines, one of the most valuable skills an Arizona real estate professional can develop is learning how to communicate clearly, remain organized, and set realistic expectations for buyers and sellers throughout the transaction. She closed Tom's file. The good news is that Tom called before foreclosure had occurred. Mark nodded. "So now we can begin exploring all of his available options." Lisa smiled. "And that's exactly what we'll cover next." Before recommending a short sale, every Arizona licensee should understand whether it's truly the best solution for the homeowner. Key takeaways. A short sale is usually the result of financial hardship combined with negative equity. Every homeowner's situation is unique and should be evaluated individually. Lenders review each short sale based on financial hardship, market value, and potential losses. Foreclosure is often more expensive for lenders than approving a qualified short sale. Real estate professionals should educate clients, manage expectations, and remain within the scope of their license. Online discussion question: why is financial hardship such an important part of the short sale approval process? Answer: financial hardship helps demonstrate to the lender that the homeowner can no longer reasonably maintain the mortgage payments. Lenders typically require documentation supporting the hardship before considering a short sale request. Question 2. What is negative equity, and why does it matter in a short sale? Answer. Negative equity occurs when the total debt secured by the property exceeds its current market value. Without lender approval, the homeowner cannot generate enough proceeds from the sale to satisfy all liens. Why might a lender prefer approving a short sale instead of foreclosing? Answer. Foreclosure can involve significant legal expenses, property maintenance costs, insurance, repairs, and months of carrying costs. In many situations, approving a short sale results in a smaller financial loss.